Hello everyone, welcome to the channel. My name is Bo and this is Seat at the Table. In today's video I got something special for you. Today we're going to talk about option trading. If you don't know what option trading is, I got you covered. I got all the details that you would need to understand what option trading is. This video is split into three parts. The first part, I'm just going to give you an overview of what option trading is. The second part, I'm just going to give you a few examples or different scenarios that you might encounter prior to doing an option trade. In the last part, my goal is to make sure that you have the full confidence and all the information that you will need to execute an option trade without fear, without hesitation, or without lack of knowledge. But before we get into this video, I just want to say I'm not a financial advisor. Anything I say in this video is just my opinion, and it should be taken as such. So without further ado, let's jump into this very exciting video. So for here, I'm just going to put on my account. I'm currently using Robinhood, and the reason for that is because Robinhood is easy to use. It's very intuitive, very easy to follow. So first, once you open up your account, the first thing you're going to do is go to search, and you search whatever stock that you like. In this case, I'm going to search NEO. So once you search the stock, we're going to pay attention here where it says trade NEO options. Now the reason people do option trading is it's a lot of reasons. Some of the reasons would be like to generate more income within your portfolio, to buy long-term stocks. Other reason could be just maybe you want to pay like an extra bill, so you want to generate that little extra income to pay that bill. Other reason would be to buy stocks at a discount. Another reason would be to buy stock outright costs more money compared to doing options. So for example, if I was to put in 100 shares here for NEO, it's going to cost me $3,625 to buy 100 shares of NEO at this current price, which is $36.25. But I could control that same 100 shares with less money with options, and we're gonna go through that right now. So if I come here where it says trade NEO options, and I click on that, and it's bringing me to this box right here, or this window. So basically what you want to do here is pay attention to these four tabs. So the first one is buy, sell, call, and put. So these are the two basic option trading method that you would use, very basic. So you can buy a call or a put, and you can of course you can sell, call, and a put as well. But what you want to pay attention to is whatever method that you're using. In this case, we're going to buy a call, so we want to make sure this buy tab is highlighted green, as you can see here, and we go on a call. Now when we say a buying a call means that you're bullish, and bullish simply means that you think the stock gonna go up, so therefore you want to buy a call, and if the stock go up, you make money. Now if you bought a put means that you're bearish, and bearish means that you think the stock gonna go down, so therefore if you buy a put and the stock goes down, you make money. Simple as that. But in this case, we're gonna go to call, and we're gonna go to buy. So once we gonna make sure that these two tabs are highlighted, the next thing we want to go to is what they call the expiration date. Now the expiration date is very important because it gives you a time frame of when your option gonna expire. And so it gives you that time frame for you to make a decision, either to sell the option or to keep the option. Whatever you want to do, the expiration date gives you that parameter that you need to be able to make a sound decision. So in this case, if you click here, you can do the 28th of May, or you can go further out. The further out you go, the more money you will have to pay, and I'll show you what that means as we go through all the different steps. So for the purpose of this video, I'm just going to do May 28th, which is this Friday. So the next thing we want to do is look at the current price. Now the current price is $36.25. So basically what I'm looking at here, based on this expiration day, I'm saying to myself, say for example today is Monday. So basically I'm saying to myself, from now, from the $36.25 until Friday, I think this stock is gonna go up to some level. Now, the level I'll have to pick a price. So in this case, I'll probably pick like something conservative, like $27.50. So now the bet here is that I'm saying by Friday, May 28th, this stock that's currently trading at $36.25 will be at this price, $37.50. So this is my bet, and this is called a strike price. That's the price that you pick. It's your strike price. So if I click here, it'll open another window up. All right. So all these, I'm gonna go over all this. But here is how much I'm gonna have to pay for this option. Now, when you do option trading, each option trade, it consists of 100 shares. So you know earlier how I showed you in order to buy 100 shares of NEO, you would need over $3,000 plus. But with options, you don't need that much money. Like you see how it says contracts? So each contract of an option consists of 100 shares, as you can see here. So this is 100 shares. So how much money would you need to control these 100 shares instead of $3,000? How much money would you need? So we can find out real quick. So the price for this target that I'm picking, which is my strike price, the cost of this option is 32 cents. Now, 32 cents times 100 shares will equal $32. So in order for me to control 100 shares of this call option, I will need to pay $32. So you see how cheap that is. So this is why people do option. So if I put in one, oh, the one is already there. So now it's saying max cost $32. Now if I put in 10, max cost is $300. So as the higher the number you put in, you just gotta multiply whatever the cost amount is by the total numbers of shares of contracts, and you'll get you'll see how much you have to pay. And you don't really have to multiply it, but it will show right here like the total amount. But just so to know how they got that number, you just have to multiply it to see how they came up with this number. So in this case, we're gonna do one contract, and we're gonna do the $37.50 strike. So after you're done with that, the next thing you want to look at is all these different details in here, like bid price, ask. So bid price means like, you know, where people are willing to pay. Ask is what the seller is asking, you know, just like when you go out, when you go to Walmart or order something on Amazon, you know, that's a price that that the seller is asking you to pay. It's up to you to agree to that price. You don't have to. It's the same scenario here. So, you know, and you just look at all these different things. And here, what we want to look at here, where it's an open interest. Now it had 5,229 open interest. What that means is like, it's over 5,000 plus people holding this particular contract within their portfolio. So over 5,000 people think that this stock gonna move from $36.25 to $37.50 by May 28th, which is this Friday. So that's what that open interest means. Now, implied volatility basically just tells you the direction the stock can move. So the stock can move up or down, either direction. This number just tells you whatever direction the stock is moving. This is what the number just basically tells you. So for example, if this number is over like 100 or 100 plus, it means that this stock is very volatile. But now that this number is below 100, this stock is very stable. Now stable means like it doesn't move a lot. So if I was making this trade And because this stock doesn't move a lot, I don't want to go further out. I don't want to pick some crazy strike price like $39, and because it's possible this stock might not get to $39 by Friday. So therefore, this number basically indicates that you want to be a little conservative, because the implied volatility is saying to you that this stock doesn't move that quick. So in this case, we'll pick this price. So it's possible it's going to get here. Now, this stock doesn't necessarily have to get to $37.50 in order to make money. As long as this stock is trending up, you're making money as well. So it doesn't really necessarily have to get here, but as long as you go up, you're making money. Now, then the next important thing you want to look at or look for is the Greeks. Basically, we just want to talk about these. We're going to talk about two Greeks, the delta and the theta. So deltas basically give you a rough estimate of how much money that you can, or how much profit that you can potentially make before you place the trade. So now, right here, as you can see here, it says 26 cents. So basically what that means, delta is telling us that every time this current share price is $36.25, go up by $1, you'll make 26 cents on each contract. So now if you have one contract here, so since it's 26 cents, you got to multiply 26 by 100 shares and you'll get $26. Just like how we multiply the 32 cents by the 100 shares, and we got $32 for the cost for the amount that we pay for the option. It's the same concept. You take the 26 cents, multiply by the 100 shares, and you'll get $26. So basically that means that every time this stock went up $1, you'll make $26 on your contract. That's what that means. Now theta basically means time decay, and what that means is that, so theta is related to the expiration date. So as time goes, say for example, if this trade was made on Monday, as time approaches, like as far as the 28th approaches, that's mean you have the less time. So as time approaches to the 28th, you have less time for this option to be in the money. Now in the money meaning like it's coming to where your strike price, which is also called the target price, you know. So in other words, time is your friend, it's your enemy. Excuse me, time is your enemy. So to be safe, the more time you have, the better it is for you. But see, this is what happens when you have more time. Say for example, if we went up to June 4th and we picked the same price, same strike. If we click on this, now at first the cost was $32. Now if you look at this, it's 82 cents times this times 100 shares. That would give you $82. So the cost went up. Why? Because now you have more time on your side. So basically the person who sold this shares or this contract to you is telling you in theory that you have to pay a little bit more. Why? Because now the trade is possibly in your favor, because you have plenty of time for this stock to leave from $36.25 to $27.50. So, you know, if you want more time, you have to pay more money. But in essence, you're playing this safe, because now you have more time more time for the share price to be fulfilled. You know, and basically that's the simplest way of doing a call option. There's a lot of other strategies out there that people use that you can use as well, but just to keep you on this, you know, to make this simple and understandable, this is a simple strategy that you can start out with and try to execute it. It's not that difficult. So you can do as many contracts as you want. You know, you can put in 10. You know, as you put in 10 contracts, if I put in 10 here, I'm doing something wrong, but anyway, you can put in as many contracts you want. You know, so once you put in your contract, you'll go here and you'll go to place order or review order, and it will tells you here you are paying $32 for the right to buy 100 shares. So basically the definition of an option is the right to buy but not an obligation. You're not obligated. So you're not obligated to anything. So in this, for example, if you bought this option today, say today's Monday, you could sell it tomorrow. Say if you're making money on it, say you made like maybe $100 on it, you can sell it anytime you want. You know, you can sell it. So that's what the part, like the right to buy, but not an obligation to do anything else. So yeah, so you can buy today and sell it tomorrow. Now you can buy today, and if you may say you bought it at 9:30 when the market opens, and you made like say $200 on it, and you felt like all right, I made a little bit of profit, I'm comfortable with what I have, I want to sell it. You can sell it the same day. Now, in order to sell it the same day, let me go back to my portfolio. Your overall portfolio has to be over $25,000. So with my portfolio at this amount, it means that I can do an option call today and sell it today, because if your portfolio is not above this amount, then the SEC has what they call daytime trading pattern. I think I'm saying it wrong, but yeah, it's something that it's literally basically means that you can't do it, you know, because your portfolio is not over that amount, the 25K amount. And this is how you do options. So options, people use it to generate money, extra income to buy long-term stocks, and I use options all the time. So I just want to make a quick video about it. If you need more in-depth video, I'm gonna like make a longer video, but for just a simple method purposes, I just made this quick video. If you like anything I say in this video, I'm new to this channel, so if you like anything I say in this video, please like and subscribe. I'm open to suggestions, anything I can do a little better. Also, I just want to say, for those who watched my first video, I just want to say thank you. For the newcomers, welcome. Thank you. I appreciate your support. And time goes by, my whole purpose for this channel is to be more diverse. So I'm going to talk about stocks. I'm going to talk about different methods and options. I'm going to talk about things that you need before you even invest. So this channel is pretty diverse. You can find a lot of information that has to do with money, but overall has to do with life before investing. So this is my whole purpose of this channel. So thank you so much for your support, and I'll see you in the next video.